Right, today we're going to look at gross income. Gross income, that's what we are looking at. And I would like you to read on expenditure. I want you to read on expenditure, then I'll just come with questions on expenditure. You see, I sent you a document. So in our next class, I'll just go straight to the questions. Because I think you know the volume of the things that we have to do. There are just a lot. So please read on expenditure, then I'll just come and do the questions both on gross income and on expenditure. So that maybe when we meet, I'll just take maybe 10-15 minutes to explain on that expenditure. Then you do the rest. Then we go straight to the questions. Some of our colleagues will be writing very soon. We are semester guys, so we need to push now. Right, so we're going to look at gross income. Right, so we'll be using this document, and I'm going to send you this document later on today. So I will send it today when I send the recording of the class. So don't worry about this document. You will definitely receive it. Right, now according to section 1, gross income is defined as any resident. In case of a resident, it's in two types. Our gross income, the definition of gross income, is in two. It comes in two phases. Number 1 for a resident, then number 2 for a non-resident. Right. If the taxpayer is a resident, the total amount in cash or otherwise received by or accrued to or in favor of such a resident. The tax in South Africa is paid on a residence basis. That means if you are a resident of South Africa, you are supposed to pay tax on all your income that you receive from everywhere. That is, if you are a resident, if you receive income from Kuwait, you are supposed to pay tax. Income from Iran, you are supposed to pay tax. Income from Ukraine, you are supposed to pay tax. From Mozambique, you are supposed to pay tax. From Zimbabwe, you are supposed to pay tax. Except, of course, we have got situations whereby there is a relief that governments agree on, which is in terms of what we call double taxation agreement. So if South Africa has a double taxation agreement with another country, they will agree that let's say for example, South Africa has a double taxation agreement with Lesotho. What will happen is that whether you're a South African or we are Lesotho, whatever amount you receive in South Africa will be taxed in South Africa. Then if you are from Lesotho or South Africa, if you receive income in Lesotho, that income will only be taxed in Lesotho. That's how the double taxation agreement works. So if there is no double taxation agreement, that means if you are a resident of South Africa, you are bound to declare all your income which you receive from throughout the whole world. Even if you receive it from man, declare that income. Right. But for any person other than a resident, if you are not a resident now, you only be liable for tax for income that you receive from a source within the what? Republic. You only be liable to receive to report on tax in terms of income that you receive from a source within the Republic. So that means if you're a non-resident, you are only liable for the income that you receive here in South Africa. The other income that you receive, you are not supposed to report it to SARS. So those are the two differences. Right. So now, the components that make up the gross income, there's an issue of a resident. We're not saying if you are not a resident, you don't pay. But there will be those two things. That if you're a resident, all your income. If you are not a resident, only the income that you receive from South Africa. Right. Then total amount. Right. Which is received by or accrued to or in favor of. Right. Then in the year or period of assessment, and which is not of a capital nature. So the income should not be of a capital nature. Now there are various issues that have to be covered now on each and every item there. So you have to understand each and every item there. Right. Now let's look at we'll start with those components to explain those components now. Right. For you to be a resident, it now says a resident is a natural person and any other person considered a resident of the republic, including insolvent estates, estate of deceased person, a trust, but excluding foreign partnerships. So that will include maybe companies that are resident here in South Africa, close corporations which are resident here in South Africa. They are also persons. Remember that a person at law is not only a natural person. They are natural persons and other persons, juristic persons. Right. So there are issues there that we say ordinarily resident. What do we mean when we say ordinarily resident? Why is this important? This concept of ordinarily resident important? Right. There are some instances whereby you can become ordinarily resident in South Africa even if you are a non-resident. So we have to know what does ordinarily resident mean. Now this term of ordinary resident is not defined in the Act. It's not defined in the Act. But we have got various cases that talk about this. We have got, like, for example, the Cohen and the Kettle cases. Right. Now, according to the Cohen case, ordinary residence refers to the place where a person will return after his wander. So that means you, if you're a South African, but you find a job in Spain, you go to America, you go to Britain, you are a soccer player, you are bought by Brighton, you are Pesitao, but where will, after your wanderings, where will you return? So as long as you go there and you come and you still call South Africa home, so the ordinary place of residence, you are ordinarily resident in South Africa. Right. So they said that according to that case, that was the Cohen case, whether you are a resident or not cannot only be determined by your action during that particular year of assessment. So you can be out of South Africa the whole year, but if everything else points that you come back to South Africa, let's say you go and work in Kuwait and the whole year you are not even in South Africa, but maybe your family is still here or your normal home is still here, that means you are just wandering with them. Otherwise, after your wandering, you just come back here in South Africa. So, according to this case, your actions during a particular year of assessment are not the only ones that determine whether you are a resident or not. We also have to consider that after all your wandering, where are you going to be? Is that right? Like this case came about because of a director who was in South Africa, but because of the problems that were caused by the World War, he was forced to go to the United States, and he worked in the United States. That was for years. So he was working in the United States for about 3 years. So the question was, can he be liable for tax here in South Africa? So that's when the court decided that where you return after your wandering, that's your home. So you will still be ordinarily resident. And according to the case of Kettle, a person is ordinarily resident where he is his usual or principal residence. So if your main home is in South Africa, but you go wherever you go, you will still be considered a resident of South Africa. All right. So we've got various cases that help us in terms of this residence. All right. So if it is a part of a person's regular course of life to live in a particular place with a degree of permanence, the person will be regarded as being ordinarily resident. That was 11. Those cases that I give. There are questions that they ask you to give cases. That's why I always refer to these cases, so that when you are asked to refer to them, you can be able to refer to them. All right. Then a person can be ordinarily resident even if he is physically absent throughout the year. The person's mode of life during that year of assessment should be considered. So we can also look at the way of life, which might mean, let's say you are in Egypt, but you are constantly improving your property here, your home here in South Africa. That will point out that you are still a resident of South Africa. Right. The place of residence must be settled and certain, not temporary or casual. So if you just come here and you work and you go, that does not make you a resident. Right. So a person is also resident where his permanent place of abode is situated, where his belongings are stored, which he left behind during temporary absence, and to which he regularly returns after these absences. So that's what we're saying, that maybe a soccer player, like Presitao is in Egypt, he went to England, but he was coming here back to South Africa. Always when he's off season, he's here in South Africa. His home is here in South Africa. He might have investments out there, but where he calls home is here in South Africa. So at the end of the day, you'll be regarded as a resident. So that means if you are regarded as a resident, you'll be liable to pay tax on all your income from throughout the whole world. Right. Now we have got what we call a physical presence test. There can be people who are not residents of South Africa, but in any particular year of assessment, they can be considered to be a resident because of their physical presence in South Africa. Right. Now there are three conditions that can make you a resident in South Africa. Number one, you have been present in South Africa in the year of assessment for more than 91 days. So that means in the current year of assessment, you were physically present in South Africa for more than 91 days. And you were present in South Africa for more than 91 days in each of the 5 years of assessment preceding the current year. That means in the past years, that is in the year ended 22, 21, 20, 19, 18, you were in South Africa for more than 91 days in all those years. Then your days should be exceeding 915 days for the previous 5 years. If you meet all these three criteria, then you will be regarded as a resident of South Africa, even if you are not ordinarily resident in South Africa. So because of that, you will now be taxed on a resident basis, just like a resident. That means you now have to declare all your income, because you are now deemed a resident of South Africa. But for you to be deemed, that means all these three have to be met. So if you meet one, and let's say you have got 91 days during the current year, but maybe over the past 5 years, there was 1 year that you were here for less than 91, then you are not a resident. Right. So now I want to look at some of the examples so that we can be able to see how we apply the physical presence test. Right. We have here a taxpayer is not ordinarily resident, but spend the following days in the Republic. let's say we're assessing the 2022 year of assessment. We're assessing the 2022 year of assessment. Right. So maybe let me just right. Let me just add something here. The current year of assessment ends on 28 February 2022. Right. So number one, in 2022, you were in South Africa for 98 days. Right. Sorry. So that means you were in South Africa for 98 days. So you satisfy the first requirement. As long as you were in South Africa for more than 91 days, then you'll be liable for this. That's number one. A physical, you fulfill the first part of the physical presence test. Then number two, we look at the previous 5 years, that is 2021, 2017 to 2021. Then we check if you spent more than 91 days in those years, in each of those years. Now, if you can see in 2021, it was 240 days. Then we have got 2020, 98 days. 2019, 105 days. 2018, 120 days. 2017, 142 days. If you look at all those years, in every year, the days were more than 91 days. That means you fulfill the second test for the physical presence test. Then the last one, we have to add your days in the past 5 years. So if we add these days, if you can see, that is from 240 to 142, they are adding up to 705. So although you meet number one and number two requirements, because your days are less than 915, you are not ordinarily resident. So you only be taxed on the income that you receive here in South Africa. So for you to meet the physical presence test, you should meet all 3 criteria. That means more than 91 days in the current year, more than 91 days in each of the previous 5 years, and more than 915 days in total for the previous for the previous 5 years. Right. Then a taxpayer is not ordinarily resident. That's another example, but spent the following in the Republic during the past year. Now, if you check the first one, you spent more than 91 days in the current year. You spent 198. So the first test is met. Then the second one, you spent 240 in 2021, 98 in 2020, 305 in 2019, 120 in 2018, and 140 in 2017.
Hello, sir.
Yes.
Can I ask a question? Why are you starting from the second year instead of starting from 98 in the first exam?
The previous 5 years. Remember, I first looked at 2022 on its own. The first requirement looks at 2022 in the current year. So in 2022, he had more than 91 days. Can you just read this?
Can I interject? Can you please go up? Yes, on the first example.
Here, the first one. For a period exceeding 91 days during the relevant year of assessment. That's number one on its own. So we look at this year on its own. That there should be more than 91. Is that right? Then number two, for a period of 91 days in each of the 5 preceding current year. So actually, we're saying this year and the previous 5 years, there should be more than 91 days. So my first test is only for this year. That's why I was leaving it out. My first test was for this year only. Is that right? Then on the second test, you are no longer looking at this year. You are now looking at the previous 5 years. Are you answered?
If you can continue, I'll catch it halfway.
No, don't catch up. It's not we can discuss that. We are saying this first test is for this year only, number one. For a period or periods exceeding 91 days in aggregate during the relevant year of assessment. That is 2022 only. We're talking about 2022 only for number one test. Then number two, we are saying for a period or periods exceeding 91 days in aggregate in each of the 5 years of assessment preceding the current year. So on number two, we are no longer looking at the current year. We are looking at the previous cycle.
Yeah, I think I messed the statement, say preceding.
Yes.
I think preceding is carrying the weight there.
Okay. So we're talking about the previous years there. Right.
Okay.
So that means when we, even the third one here, it's preceding. The 915, we don't include 2022. We're talking about 2021 going forward. That's why we look at the 915. So when you're looking at the 915, you don't look at the days in the current year. You look in for the days in the previous 5 years. So the 915 days limit is for the previous 5 years. But of course, the current year should be more than 91. Right. So now, on the second test, so we said this one, the first test, I think now we can be together, same. The first test is that in 2022, our year of assessment, we have more than 91 days. So this taxpayer had 198 days, which is more than what? 91 days. So he fulfills the first test. Are we together there?
Yeah.
The next test now is to look at the previous 5 years. We should check if each of the previous 5 years he had more than 91 days. So now if we check 2021, he had 240. 2020 he had 98. Right. 2019 he had 305. 2018 at 120, 2017 at 142. So all the previous years had more than 91 days. So you fulfill the second test, objective test, the physical presence test. Then the final test now looks at the days in total, excluding this year. That is the previous 5 years only. They should make up 915. So we add 2021 up to 2017. So in this case, we found 1,005 days. So because the 1,005 days are more than what? 915. So you are now ordinarily resident in South Africa. You will now be taxed the same way as a resident. So here, we're saying you will be considered an ordinary resident since all the 3 conditions are met. You meets condition 1, 2, and 3. Is that clear there, my friend?
Yeah, it's clear.
Right. Then my final example here.
Sorry, Tim.
Yes.
On the second example, I think you should correct there. Therefore, he is not ordinary resident. The one of 1,005.
It's wrong.
Yes, I think you should correct there.
What are you getting?
He is ordinary resident, not.
He is, yeah. This is the answer. Here is another example. He will be considered ordinarily resident since all 3 conditions are met.
Oh, the one above that. Look at the sentence at 77.
He is
77.
not. He is not.
No. Cell 77 there.
Hello?
Look at the cell 77.
Oh, you mean this one? Okay.
Yes.
Okay, I see it. Thank you so much.
You're welcome.
Thank you so much. Right, the next example, maybe so that I can also put a demarcation in case, because I know that our friends are not here. Maybe let me do this so that they can also understand that these things, where is the demarcation for these things. Then here, I would say this is the conclusions. Then here I would call it Right. Now on example 3. Right. From the current year, you spent less than 91 days. So already, you don't even have to go to the other test. Because in the current year, you spent less than what? 90 days. So that means you are done there. Although you spent more than 91 days in each of the previous 5 years, if you check there, those were more than 91 in each of the previous 5 years. In the total days, if I can check, let me just verify the total days. They are 905. So it doesn't meet the first and third. Maybe let me just write those also. Right. So I can say you spent 91 days. Then he spent 905. Which is less not a resident. So on example 3, there are 2 criteria that are not met. Number 1, he spent less than 90 days in South Africa during the current year. And then number 2, the total number of days were 905, which is less than what? Which is less than 915. Right. Then we go to the last example. Right. So we can say the first one. Right. If you can check, in 2022, he spent more than 91 days. So he spent more than 91 days during the year of assessment. Right. Then we also add up the number of days in the previous 5 years. $938, which is greater than 1015. So you'd find that this guy, he meets the first and third requirements, but he misses the second, because in 2020 he was only there for 91 days. 91 days does not exceed. It's not 90 equal to or equal, or it's not greater than or equal to 91. It should be greater than 91 in each of the 5 years. So the fact that he only spent 91 days exactly, that means he doesn't meet the criteria for ordinary residence. Right. Any questions on the ordinary residence? Right. Then for you to be checked, yes.
Eugene, on 2018 is not supposed to be 160. I see you wrote 120 when you add them. 2018, 2018.
Yes.
On the contribution, when you add them, it's 240 plus 198 plus 205 plus 120. It's not supposed to be 160.
Which is supposed to be 160?
120 plus 140. Well, I don't understand that 120, 305. On the contribution, 105, cell number 105.
You are saying, okay, it's supposed to be one what?
160.
240 plus 91. No, you see what happens? I made a mistake, but that I copied that other one from there. I think even this one should also be wrong.
Yes.
It's supposed to be what?
Yes.
240 plus 98
plus 305. That one is correct.
The total is correct.
Yeah, the other one is correct, but the one for 120 is supposed to be 160, not 120.
Okay, yeah, I think you are right. Let me just read. I just copied and pasted there. That's the problem.
Example number 4.
I thought I was just using the same number. Okay, the total is correct. So here, when I come here now, it's supposed to be 240 plus 198.
No, 91. 91, Eugene.
Yes.
Yes.
It's like 240 plus 91.
Yes. Plus 305.
Right. Then we add what? 305.
305.
305.
Thank you so much.
Plus
160 now.
Yes. Yes.
Thank you so much. Then 142. Right.
Yes.
Then we'll now say 240 plus 91 plus 305 plus 160 plus 142. 938. Is that right?
Eugene, can I please ask a question?
Yes, you can.
So you are saying in terms of this 91 days, right? So everything, including the current year, is supposed to be plus 91 days.
More than 91 days, not 91. More than 91.
So if 2022 was 92, it was going to be a resident.
No. The fact that if 2020 was 92.
Yes.
Yes, he was going to be a resident.
Oh, okay. So that means
2020 that became a problem here.
That means if 2022 is also 91, it will be rendered not a resident.
As long as in any of these 6 years, that is this year and the previous 5 years, if you had a year that is 91 or less, that means you are not a resident, according to the physical presence there.
Thank you.
Are you answered, my sister?
Yes, I am. Thank you, Eugene.
Okay. Right. So that's number one. So the issue of a resident or non-resident, please be very clear. It doesn't make you not to pay tax. It only determines whether you are going to pay tax on all your income or only the income that you got in South Africa. So all those guys that were saying they are a resident, even if they are, normally they are not a resident, that means they were now supposed to declare all their income, including that they got from their home country. Is that right? Let's say someone is from Swaziland. Is that right? But then they spend more than 91 days in each of the previous 5 years. And in the current day, and in total the days are more than 915. They are now required to report just like a resident. That means to report all their income that they got, including the ones that they got in Swaziland, when they report to SARS. So the residence tax just determines the basis upon which we determine your tax. That should we determine it on all your income that you get throughout the whole world if you're a resident, or if you are not a resident, only the income that you get from South Africa. That's the purpose of the residence test. Right now, the second thing that for you to be taxed, there should be a total amount in cash or otherwise. There should be a total amount. Right. So an amount is not necessarily cash. It can be, you can be given a laptop. You find the value of that laptop. So so for there to be taxed according to CIR versus Butcher Brothers, there must be an actual amount received or accrued before there can be a question of gross income. So before we talk about does it qualify as gross income, first of all we should understand was there an amount. And the term amount according to Letgard versus CIR, the term amount does not only mean money, but every form of property the taxpayer owns. So I can go and do work for you, then you give me a laptop or you give me a car. We have to value that car. That's the total amount. So my total amount will be in the form of that car. So that's also supported by less property mind. That when you receive an item which is not money, it should be valued. And the value, we normally use the market value of the asset on the date that it was received. What is the market value on the date that you received that asset? That's the total amount. So for you to pay tax, it doesn't have to be necessarily cash only. It can be cash or any other amount. Any questions on the total amount in cash or otherwise? So please, guys, you should know some of these cases because there are some instances whereby you might be needed to court, because there are questions that they ask you that you should include case law. When they say include case law, include some of these cases in your discussion. Right. The third thing, for an amount, it should be received by or accrued to or in favor of. So it's either received or it's not received or it's accrued. So received was saying you are given the money. Or maybe it's a laptop or it's a car you are given, that's received. Or accrued to you. For example, if someone buys goods on credit from my shop, the amount is already accrued to me, although I didn't receive the cash. So this necessarily means that even if you have not received the money, but as long as you are now entitled to the money, that means it is now your income. So shops that sell on credit, the moment that they sell, the income is now theirs. They are supposed to report the income. So according to Silver Glen, an amount will be considered in gross income if it is either received or accrued, whichever happens first. So if it is receiving or accrual that happens first, you include it in income. So that means prepaid income, if you receive income for 2024 now, you should include it in income because whichever happens first will determine the inclusion in income. Right. According to Keldenes, just receiving money does not result in inclusion in gross income. If I send you to go and collect my money in Joburg, and you get that money, you have not received money. You can't include it in your gross income. The money that you are collecting is for Eugene. So at the end of the day, I'm the one who is supposed to include it in my gross income, not you. So if you receive income on behalf of others, then it's not your income, it's the income for that person. You are receiving the income on behalf of. So that person is the one who is supposed to declare that income, not you. They were just trying to remove the issue of if you just say received by. That means even if I receive on behalf of my company, I've received money, or if I receive on behalf of someone else, I've received money. It's not like that. You only receive if you are receiving it on your own behalf. Right. Then on illegal receipts, illegal receipts are also considered to be for tax purposes. You have received. For example, if you overcharge a customer, that money is your income. It's included in your income. Money stolen. If you steal money, that money will be considered as your income. So it should be included in your tax. You should say, I stole money. This money I should pay. I'm coming to pay tax to us because I stole it. Right. I know this is like cases where maybe someone is caught, they've benefited from money, and they stole it. That money can be taxed in their hands because they received it, as long as they stole it for their own benefit. Right. Then when they defined accrued, in Letgan, accrued is when you are entitled to. When you are entitled to, if you provide a service to me and I owe you money, then you are entitled to that money. Right. Then there's a section that talks about blocked foreign funds. If you have got money in a foreign account, which you cannot transfer to South Africa, then you can have a reprise. So that means you qualify for what is called a Section 9A special deduction. So that means you include it in your income, but then you deduct it. So you won't pay tax on it. Then next day you revisit. The previous amount is added back, then we revisit and see if it still qualifies. Now deposits. You can receive deposits. For example, I think most of you when you rent, they will ask you to pay deposit. When you buy some things like drinks, they can ask you to pay a deposit. When you are buying in a shop, they can ask you to pay a deposit. Right, a deposit, as long as you put it in your account, that you use money on a daily basis, that money should include it in your gross income. That means you can only exclude money from gross income, the deposit, if you have a special account whereby you deposit that money and you don't take it out. You don't withdraw it. It's just in that account until you pay back the deposit to the owner. In that case, you will not include it in your gross income. But as long as it's just in your account that you normally receive money which you are using for your business, then that money has to be included in, because it's like you are using it for your benefit. Then maybe when you now pay back, that's when you will have to deduct it again. Right. So that's the issue about deposit. Right.
Sorry, Chin.
Yes.
What if I'm the one who has paid the deposit?
What's
like
on gross income?
Yes.
Remember, we're going to go to expenditure.
All right.
So that will depend on the circumstances. If you are paying a deposit for an expenditure, that is normally that you can be able to receive back. That will depend on the nature. Like, can we take it as an amount that will come back to you, which is not an expenditure per se? Then if it's not an expenditure per se, we won't be given a deduction because you're going to get your money back. So we're going to talk about that when we deal with expenditure.
All right, thank you.
Or in favor of. Right, we said received by, accrued to, or in favor of. So that's the one that we are saying that if someone receives money on your behalf or receives an asset on your behalf, you have already received. That means you are supposed to declare that income as part of your gross income. Of course, we're going to learn later that there is income, you include in your income, but then it can be exempted. Then when it's exempted, you then have to subtract it again. Right, but if the first thing is it has to be included in gross income, if it's your income. So not all gross income will be taxed, but it has to be included. then some of it will be exempted. We're going to learn about that. Right, then a receipt or accruals of a capital nature. Right, if the receipt is of a capital nature, then it will not be included in gross income. For example, if you sell a building, that's of a capital nature. The sale of the building, you don't include that amount as a receipt in gross income. But rather, we're going to learn that you have to calculate your recoupment or scrapping allowance. Right, the Act does not define what is a capital nature. But we've got a lot of tests that can be carried which help us to determine whether an amount is of a capital nature or not. Right. In Commissioner for Inland Revenue versus Visa 8 SATC 271, there was the tree and fruit principle, which was used, in which if the income is the tree, it is considered capital, and when it is considered to be fruit, it is regarded as a revenue. Right. If you sell goods, that's what we call a fruit. It's money that you can what? You can use now. You can consume now the money that you are receiving. Is that right? But when we're talking about a tree, when you sell equipment was a tree because you were using it to produce income. You were using that machinery to produce products that you could sell. So the purpose of that machinery was to produce. So it was a tree which was bearing fruit at the end of the day. Unlike the day-to-day sales, which we call the fruit. That means after doing the final receipt from your normal trading, that will be what? Your fruit. So that was the example that was used in that case. Right. We have got what we call the subjective test and what we call the objective factors. Subjective tests, we're saying they are subject to interpretation. Not all of us can arrive at the same conclusion. So it will be SARS and maybe the courts will have to decide whether an amount is of a capital nature or not. Right. When we are carrying out a subjective test to see if an amount is of a capital nature or not, we look at the intention of the taxpayer. What was your intention when you were buying the item? So like today, I can buy a piece of land because I heard that it's very, very, very cheap. And I'm buying it so that I can sell it very fast because I saw that it's cheap, so I would like to sell it. Right. So they look at your intention when you bought the asset. So that can be one of the factors that can be. So if you can see here, it's not saying that's the decisive factor. They said in some circumstances may be fundamental and decisive. So in some circumstances we can use the intention of the taxpayer. Right. Then there can also be change of intention. So the intention at the time of acquisition may change. Let's say you buy a property, then you do activities. Maybe when you bought it, you wanted to use it for a long time. You buy a building in an industrial area. You wanted to use it for manufacturing. But whilst you had that building, then you had information that you bought it at a very cheap price. The buildings in that area are very expensive, more than that. And then when you hear that, then you start to do activities like repainting, repairing, and then you immediately sell, whereby it can be seen that your action or a preparation to sell it. So there can be a change of intention. That is, in the beginning, although you wanted to make it a capital asset, that means when you sell it, it's not of a capital nature, but your action, they have shown that it was no longer of a capital nature, it was now of a what? it was not of a capital nature, so it will be included in your gross income. All right. So the intention can be of a company, if we're talking about a company, can be derived from both its formal act and informal act. So that means what you do formally, that means in your discussions, in your meetings, and your express statements on what you need with the assets. Or informally, that means outside your other acts, as I said, they can show something. Right. Then they can also be what we call mixed intentions. That means from the circumstances, it seems as if you want the asset to use it, and at the same time you appear as if you want to sell it. So we look at what we call the main or dominant purpose. What is the factor that is dominating between the two? And as the heading suggests, these are subjective tests, as you can see, that it can be very difficult to tell. But it's up to interpretation usually of the court or SARS to see that was it of a capital or not of a capital. So if it's of a capital nature, it's not included in gross income. If it's of a capital nature, it's included in gross income. Right. Any questions on the subjective test? Right. Then we've got some of the what you call the objective factors. Objective factors. Right. There are many objective factors that we can use to determine whether it's a capital or revenue nature. The manner of acquisition. If you buy using your own money or you buy using a long-term loan, that might be an intention that you want to use an asset for a very long time. But if you take a short-term loan, that is Strathmore Holdings here. If you you take a short-term loan to buy the asset, where other circumstances do not point out that you had the other sources of paying that short-term loan other than selling that particular asset. So it can be determined that this asset is not of a capital nature. You actually bought it so that you can what? You can sell it. You take a 2-month loan, and from the circumstances, it's very clear. Let's say your business has got sales of maximum sales of 100,000. Then you take a loan of 500,000 to buy an asset, which you then sell after a month for 600,000. And the loan was for a month. So it can be seen that it was well calculated, that you knew that within a month you could sell that asset because your business could not sustain that short-term loan. Right. The manner of disposal. If you buy an asset and immediately you are very busy advertising it, that can show that you really wanted to sell it. Than something that just comes up that maybe you didn't want to sell it, then someone comes up and then you find an offer that is very difficult to resist, but it was not your intention. Right. Then the period, it can also lead us to understand. If you sell it very, very fast, that can be sure that maybe it was not of a capital nature. But if you take time, if you sell maybe after 10 years, you sell a machine, clearly that means it was the fruit. That machine was a fruit. Then continuity. The number of transactions that you take. If you buy a building, you sell it. Buy another building, you sell it. Buy a building, you sell it. It will be very clear that you are in the business of buying buildings and selling them. So the more the number, the frequency of non-current assets that you are selling, it will mean that you are trading in that non-current asset. They are not of a capital nature. They are actually your stock. So the more the number of similar transactions on capital assets, the more it is likely that you are trading them and they are of a capital nature. Right. Then occupation of the taxpayer, your job. If you are into trading shares, whenever you buy shares, it will be almost obvious that those shares are for trading. If you are into selling houses, if you now buy a house and sell it, we would assume that it's a part of your job. Right. Then no change in ownership. You buy a car, you sell it without even changing it into your name. You buy a building, then you don't change it into your name, then suddenly you sell it and it's changed to the other person's name. That can show that from the beginning you didn't want it to go in your name. That means it was of a revenue nature. Nature of the asset. If it's a non-current asset, that will show that it's of a capital nature. But if you sell stock, that will show that it's of a revenue nature. All right. Then we can also look at the reason of receipt. Let's say you received a building because you did a job and then you sell that building. That will mean that that building was actually income. So even if you disguise it as inheritance, a gift or donation, because you can disguise something as a gift because there are tax concessions there. Then you say it was donated to me, when actually you are getting it for work that you did. Right. Legal nature of the transaction. For example, a lease over 5 years. Is that right? Whereby you are renting a house, that will show that that income that you are getting is of a what? Revenue nature. The lease payments for an asset, that means it's of a revenue nature. Remember that SARS will just take a lease as income. That would be tax in the hands of the taxpayer. All right. Then other factors, you can consider the age of the taxpayer, the nature of the assets, and the taxpayer's activities. That is just before the sale. I think we talked about that anyway. Then the accounting treatment of the transaction. In your books of account, if you include an item as an non-current asset, then that will be what? That we can assume that is of a capital nature. Any questions there? Right. So I want you now to look at on your own. I want you to look at special inclusions. I want you to look at exemptions and deductions. You also look at the definition of a deduction. So what I will do, I've got those questions that I sent to you. We'll discuss the deductions through that question, and then we'll also talk about the incomes through those questions, and then we'll talk about the prohibition, that is prohibited expenditure through that. So please, I want you to read on that so that we can push on time. Then we'll go to the questions, then we'll discuss the part of the expenditure and part of the income. Do you have any questions? Right. If you don't have any questions, then I can safely say you can enjoy your weekend. So then we'll continue when we meet. But please look at those things that I told you.
Hey, Baba, assignment.
What is assignment?
Hey, you know what?
What is assignment? If I can understand.